Welcome to the Crypto Prism channel. Let's take a look at Bitcoin's latest market structure. From the current 1-hour structure, the 71,800 level I mentioned is now the key pivot point, the dividing line between bulls and bears. It is indeed a dense trading zone, formed after the recent decline, and it overlaps with previous rebound highs. Every time price approaches this level, clear selling pressure appears and pushes it back down. It then falls back toward the 70,000 area, where it repeatedly finds support. This shows a box range forming, with a ceiling above and support below dot at the moment. Price is more inclined to repeatedly test resistance, but momentum is insufficient. Each rebound toward the 71,000 area is repeatedly pushed back down. Moreover, the pullback does not immediately produce strong consecutive bullish candles with expanding volume to engulf the overhead supply. Instead, price is moving sideways to consume time, using consolidation to digest selling pressure. Under these conditions, for a direct breakout to occur, two key signals are required. First, price must effectively break and hold above 71,800, preferably with a 1-hour candle closing above it, followed by a successful retest that holds and pushes higher again. Second, the breakout must be accompanied by expanding volume and solid-bodied candles, not long upper wicks. If upper wicks appear during the breakout attempt, that would signal a false breakout. Before these two signals appear, the probability of continued rejection and pullback remains higher. Therefore, each failed breakout attempt consumes bullish buying patience, and the support around 70,000 becomes thinner. It becomes easier to trigger a pullback toward the lower boundary of the box range. From a trading perspective, the rhythm can be simplified. Below 71,800, treat the market as range-bound. Focus on short-term support at 70,000 and 69,800. If those levels break, the probability increases of a pullback toward shallow structural support around 68,000 to 69,000. Further down, watch the round number support near 68,000. On the other hand, if expanding volume appears and price breaks and holds firmly above 71,800, the structure will shift from box consolidation to rebound continuation. Upside targets would then be 72,800 and 73,500, previous highs in dense trading zones. Looking further up, 74,000 becomes the next resistance level. Overall, price does not have to break out immediately, nor does it have to break down. It is currently a weak consolidation under 71,800 resistance. Bulls must prove the breakout by reclaiming and holding 71,800 with volume. Otherwise, price is more likely to pull back, to build stronger support at lower levels, and accumulate chips for a renewed push higher. Now, let's look at the weekly chart from the current weekly structure. Last week printed a high-volume bearish candle with a long lower wick. This type of bearish candle conveys that there was clear panic selling, and even capitulation during the week, quickly driving price down to the long lower wick area around 59,800. However, strong buying support later emerged, pulling price back up. This indicates there's capital absorbing at lower levels and defending support. But since it ultimately closed as a bearish candle, it shows that although bulls caught the most dangerous decline, they have not regained control. Overhead selling pressure remains heavy. The essence of the market on the weekly time frame is still a decline, with weak repair. Looking at the indicators, RSI has dropped to around 30 or even below, a typical oversold zone on the weekly chart. This suggests that downside momentum has been largely released and the space for a continued one-sided decline is being compressed. What we are more likely to see at this stage is a technical rebound or a consolidation repair to digest the oversold condition. At the same time, looking at KDJ, it is also at a relatively low level in the 28 to or 30 range. This indicates extremely weak short-term momentum. The market is in a deeply oversold state. If the weekly chart subsequently prints a solid stabilization candle, such as a small bullish candle, or another lower wick that gets reclaimed, combined with KDJ turning upward at low levels, or even forming a golden cross, then there's a high probability of opening a weekly level rebound window. However, looking at MACE, both lines remain below the zero axis, and the histogram is still red, indicating bearish dominance. This means the midterm trend has not reversed. Even if a rebound occurs at this level, it is more likely to be a counter-trend rally within a broader downtrend, not an immediate return to a bull market. Based on this, the probability of a rebound driven by oversold conditions is increasing, but a true trend reversal still requires confirmation in the short term. We must observe whether the weekly support around the lower wick low near 59,800 can hold effectively as long as there's no high volume breakdown below it. Price will likely consolidate above this support and attempt a rebound, whether that rebound can upgrade from a technical pullback to a full trend reversal. That's it for today's video. See you tomorrow.